Hello. Hello, everyone. Can you hear me? I think you can message me on. Just we have 5-10 minutes. We will start at 10 o'clock. Good morning, guys. I hope I am audible. Okay, good. Good to hear. Just one more minute and we will start. Very interesting topic. We will see how it can help us. Okay, so let's start. So today I'm going to take a small webinar, not very long, about a very interesting thing which we call it as collar. Okay. What is this collar actually it is and how it works and how it actually help us to have a sustainable income. Okay. So before I start, I have a disclaimer to give you all guys, which is I think is important. Okay, because this session is for educational purpose only. and should not be considered as financial, investment, or trading advice. The information presented is intended to provide insights into the collar trading strategy and is not a recommendation to buy, sell, or hold any financial instrument. I am not a registered financial advisor and I am not authorized to provide specific investment advice. Participants should consult a qualified or registered financial professional before making any investment decision. Trading and investing involves risk, and individuals are solely responsible for their decision. I'm not responsible for any financial loss or damage resulting from actions taken based on the information shared in this session. By attending the session, you acknowledge and agree to these terms. This is very important because in our life, when we do trading, there is no guarantee of anything. But yes, there are few things which you can do and mitigate our risk. So I'm going to show you how we mitigate the risk and sleep peacefully. Okay, let's move on. So, what I will show you all today, what is why safety is in investing matters. So why, when we invest our money, why safety is matters there, basics of stock investing and associated risk, overview of hedging techniques with options. So when we invest in stocks, we have risk because it can increase, it can decrease, but we can hedge our risk with options. And how to trade using collar. From all the techniques what I saw, I say collar is the best, no stress, and you get results there. And finally, we have examples and questions and answers. What's the objective? By the end of this webinar, you will understand how to implement a collar strategy to mitigate risk while maintaining growth potential. Remember, I'm not saying there is no risk. I'm saying mitigate risk. Suppose yesterday you went ahead, you said, I want to do a laptop business. So you went ahead, you bought a laptop and you are planning to sell. You bought it for $100 and you thought you will sell for 150. Maybe you found somebody for 150. Great. Maybe you didn't find for a month, 6 months, year. What will happen? Your $100 is a loss there. So any business has risk and loss. So the same thing here also applies. Stocks also has, it's a business, it has risk and it has loss also. But we should know how to mitigate the risk. Now I'll give you one more example here. You buy a car. Okay. Now you are driving a car, you can have an accident with the car and your car can get damaged. So what you will do? You bought 50,000, 60,000 car. You go ahead and buy car insurance, right? When you buy car insurance, and if it is a 50,000 car and you got an accident, car insurance doesn't give you 50,000. They give you 50,000 minus the deductible. So if you have chosen $1,000 deductible, they will give you 49,000 if your car is towed away, right? So when you take an insurance, you have two parts. One part is the premium what you pay for the insurance, and when you get the money, maybe you may pay the premium for the car for 1 year and nothing happened to the car. So what happened? In a 1 year, you enjoyed the car, but you lost the premium what you paid. You should be happy with the premium gone because your car didn't happen anything, because that premium was for the safety of the car. Second thing is there, you took the premium based on deductible. So if you say I have 500 deductible, you pay more premium. If you have 1,000 deductible, you pay less premium. The same thing we apply here on stocks also. Okay, let's see how we do it. Now, before we start anything, I have a graph of a stock. You may be knowing this stock, Trump Media and Technology Group. This is Trump's own Twitter. Okay. So people who bought this Trump on July, it was around $28. Next day they were very happy. Next day very happy. Next day very happy. It reached 40. Then suddenly what happened? Maybe they didn't sold. It went down. So imagine the stress. You bought for 30, you are at 40, you didn't sell it. Then suddenly it goes up. Then you says, okay, I will sell, I will hold. You are in a confusion. What shall I do? You didn't sell, it went to $12. Imagine your capital is more than 50% gone. Then suddenly it starts increasing. It goes to 52. Maybe someone bought, because each of these graphs says someone bought or someone sold. So imagine on 52 there is a huge volume. So many people bought at 52. Now it's not 52, it's 30. Their capital is already 50% gone. Why I'm taking this example? This is a extreme example, but all shares has risk. If you put buy share, there is no guarantee in the world that tomorrow it will go up or go down. There is no one can say guarantee. If anybody says guarantee, they are either the market maker, or they are the boss, or they are lying. Nobody can tell it. So how do we handle this? And if you see that Trump, if people who didn't buy, they lose. But people who bought, maybe the people who bought here 12, they are still in profit here right now. So I cannot say you don't buy, I cannot say you don't sell. But is there a way we can buy and protect our capital from losses and then move ahead with it? Maybe I don't want this much profit. If I get 25-30% a year, it's a huge return, and protect my capital. How about that? How about if I can do it consistently and get 25? Because remember, if you can get 24% a year return, you will double your capital every 3 years. So if you start with 10,000, after 3 years it will be 20,000. After 3 years it will be 40,000. After 3 years it will be 80,000. So you should look about how to generate a consistent income, not one lottery ticket. Okay, I buy one and then it become jackpot. Because even if you buy a share and you made a lot of money, you will never be happy. You will come back again. You will say, I will buy again because that made me money. I want to make more money. So need of money in our life never ends. So we should know a technique which can give me consistent money, not too much, not too less, and it goes by itself. Now, one more thing is there. If you want to trade in markets, you need money because it's a business. Any business needs money. You have money, you will make profit. You don't have money, you took money by loan, you will have stress, and then you have to pay back the loan. So that is not easy to make money in the market without investing any money. Doesn't matter what you put, $500, $1,000, $2,000, anything you use, you start with any amount, but you have to put money. Okay, so first I have an example about options. What is options? So options are financial derivatives that give the holder the right to buy and not the obligation to buy or sell the underlying asset. Means if you hold an option, you have the right, but nobody can force you to buy. It's your choice, you want to buy or not. Okay. So that at the predefined determined price, I have made a very interesting video on options, 10-minute video. I'll put a link there where you can see there how options are actually created. So based after all my study and going ahead, I know one thing: options are used for best used for hedging. Why? Because I'll give you an example here. Okay, I'll give you here one simple example. I'm going to a website called optioncharts.io, and then I choose SPY. So SPY is what? SPY is US Standard and Poor S&P 500. So S&P 500 has the best 500 stocks of United States of America. So these 500 stocks will have given consistent return of 12.5% per year. So if anybody who had not put any brain and just purchased this one, this ETF, they would have got 12.5% consistent return over a period of time. Okay, this doesn't happen every year, but it happens over a period of time. Now look at this options chart. And what I'm going to do, I will select all and done. Okay. So these are, do you see people has bought options? Some, if you see here, there are 12,000 or 7,000, some numbers are written. People have bought options. Why do you think they bought options, and who are these people? These are all hedge funds. Hedge funds means Canada pension funds, or then you have your Bank of America, Bank of Merrill Lynch, or Goldman Sachs. Those people, because what happens, they always come to tell you, I'm going to protect, I'm going to have your pension money. So pension money, they take your pension money, they have to be make sure they don't lose the money and grow from there. So how they protect it? They protect it by options. So if they have 100 shares, and if they say, because they don't work on 100 shares, they work on millions and millions of shares. And then if they start selling those shares, what will happen? The market will go down. So they cannot sell the shares on market. So what they do, they buy protection. So see, if you see here, there is a put open interest at this price. You see how much put is there? 574,000 puts are already purchased at this price, 440. Why? They are fool. They spend this money. They spend this money for a protection because they already have shares of S&P 500. And tomorrow, if suddenly Iraq attacks, or suddenly the escalate the war between Ukraine and Russia, what will happen? Market will fall down like anything, and then in that case, everybody loses money. So they already bought this put in that anticipation. If market doesn't fall, what will happen? They lose the premium. That's all. Same like in your car. You drive your car, you don't have an accident. What happens? You lose the premium, and then next year you again put it. But you enjoy driving the car. That's what it is all about there. So options are used to hedge. That is the most important thing of options. Okay, there are two types of options. One is call options, which give you the right to buy, and there is put option, which gives you the right to sell. And options has few terms like strike price. It's the price on which two people agree. There is an expiration date of a option. After that date, the option is not valid. And there is a premium. You pay some premium because everything people think in future it's going to be expensive. So options can be used for speculation. This is the danger part. This place we lose lot of money. If people make $100, because of this speculation they lose. Income generation or risk management. Our job for options, or if I am teaching this session, or if somebody asks me, my purpose of option is only and only risk management. Because we cannot make money from something which doesn't exist. We can make money from something which exists. If you buy 100 shares of Apple, actually it's tangible. You have the right on Apple company, and then you can use options to hedge your position. How? I will show you right now. So how are options used as a hedge? What means hedging? Hedging means a risk management study to offset potential loss in one investment by taking a opposite position on another investment. So let's say I bought Apple for 220. Now what happens tomorrow? Apple price can go down anywhere. It can become 240, it can become 220. What if I bought a insurance or a put option at 225? What will happen after that? If the price of Apple goes below that, I'm going to lose on shares, but my put option will start gaining value. And then I can cover my losses through that option. Maybe little not clear, it will be clear. So how do we hedge options? We have two ways. First is my protective put. So buy a put option while holding the stock to protect against downside risk. So I have a stock, I buy a put option. That put option will help me what? To protect my losses. If anything happen, it goes down, the put option will save me from losses. Then another hedging strategy is covered call. Sell a call option while holding the stock to generate income, capping upside potential. What it is, I will tell you both. So when I join both of them together, it becomes a collar. Okay. Benefits of hedging with options: it limits potential loss. Imagine how powerful it is. I buy Apple for 230 and I put a hedge, or I bought a put at 225. Suddenly Apple become 200. So officially I lost $30 on Apple because 200 minus 230 30. But my put option will become 25. And then I got $25 from the put. So actual my loss was only $5. And now Apple is available for 200. I can buy again Apple at 200. So it helps you downside risk, plus it makes you get out. If there is an issue, it can get you out easily without any problem. And once you are out, you are free with money. You can do again what you want to do the trade. Okay. So it limits potential loss, provide flexibility compared to selling shares outright, and cost effective compared to other hedging methods. I'll show you an example, then you understand. So for a stock, I need two things. One is protective put, one is covered call. Okay. So what's a collar strategy actually? It's a conservative option strategy. We like conservative because the money what we put in market is very hard earned money. It's We are not hedge funds like someone else money. I took it and take a signature from them that if you lose your money, it's your responsibility. No, it's our money. We cannot lose it. So we need a conservative strategy to protect our money. If we can protect and get 24 to 30% return, that's it. 24 to 30% is huge. No business can give. Even S&P 500 gives you 12%. And if you see big companies, their return on investment is maybe 5%, 8%. If you can get 24 to 30%, you just need to wait for a time when you have money. You keep on adding zero and it will give you. It's not about winning one trade. It's about consistently making money. So, a conservative option strategy designed to protect against stock price drops. It involves three components. First is you have to buy stock. I told you before, you need money to buy stock. Second, you buy a protective put and you sell a covered call. So you do all these three together, it becomes the collar. Because why do we sell a call? Because when I buy this protective put, the insurance, I have to pay premium, which going extra from my pocket. Sometimes you will not like, oh, why I'm paying premium. Okay, so we can cover that premium, some of the premium by the call selling. So at least your cost of insurance will go down. Uh, I will show you how they affect your profit and loss graph. So why do we use collar? There can be hundred of strategies, but this is the only strategy which can make you money consistently. Okay. I don't see many people talking about this because they take unlimited risk. There is no risk. We can't take risk because this is our hard-earned money. Okay. Why use the collar strategy? First, its benefit is limit downside risk. Second, it reduces net cost compared to buying put alone. If I use collar, my cost will be less. Less will cost for insuring my shares than to having puts alone. Maintains upside potential. I get some money on the upside. That's why I said only 24%. Okay, not more than that. So if it goes 50% return, you will not get. You'll get only 24. So you have to decide your greed there, that I want this much only. Then only this will work. It is ideal for investors who already own stocks and looking for safe, cost-effective hedging. So how it works? There is very important thing with options. Options always works on 100 shares. So you cannot work on 10 shares with options. If you're going to work with any company, any share, you have to hold 100 shares of it. Then only you can work with options. Else, it doesn't make sense. I told you, options were designed as an exit criteria for big investors when market fall. So if you remember 2008 fall or 2016 fall, big investors, They already sign a contract with people through options where if market fall, they will be out already before time. So this is the way options are used. So first you have to own 100 shares, maybe at the strike price of 50. So 50 multiply 100, you pay 5,000. Then you buy a put at 48, premium of $2. So now what happens? If it crosses 48 and go down, your put will become active because it will become in the money. I have talked in the video about in the money. You may wish to have a look. I will put a link there. And then we sell a covered call at strike price 55. So what happens? Because I buy this put, I have to pay some money on top. That money, if I don't want to pay, I can use the call to reduce that money. And then my net cost becomes zero. And outcome is if XYZ falls below 48, your losses are capped. And if XY rise above 55, you don't get more than 55. But you should be happy. You bought 50, you sold for 55. You already made $5 profit. You will not get unlimited profit, but you can't get everything. If you want to make unlimited profit, you have to lose this part. Then you are keep on paying option premium on every trade, which will be expensive over a period of time. Because I'm not talking about one trade, I'm talking this doing every time, again and again, again and again. So this premium, if you can offset by this, now you are there. You have a $2 loss, $5 profit. If it goes down, you will try again, but your loss is only capped. You can have four things in a market, either big profit, big loss, small profit, small loss. You have to take care of big loss only. If you can take care of big loss, you'll see money, not one day but over a period of time, because you will be having more successful trades and less loss making trades. And then you will see over a period of time you are seeing the money growth. I'm taking this session today. I started collar on February. To see the results, it took me 9 months, and then I say yes, this is the one which gives the result consistently. I did it more than 100 times on different stocks, and then I came up on the result. Let's see real life example. This is the latest one. So Apple price today is 229.73. Apple price today is 229.73. As per what I said, we'll be buying a put. So if you see 227.50, 6 days from now, I'm keeping very short expiration. In real life, you should work for monthly expirations. They are a bit cheaper. So 6 days from now, Apple 227 put, I'm going to buy for $1.07. So first of all, I will buy Apple for 32 20 229 multiply 100, so almost $30,000. 30,000 is too much, but this will apply on any stocks. Okay, for my example, I take Apple. So 30,000 Apple I buy, and then I buy put for $1. So I paid $100 extra, and then I sold 235 call for $37. So my net cost came 107 80 cents. So 80 cents extra I paid, and now I sit down. So my profit and loss graphs for the next 6 days is what? This is my profit and loss graph for my next 6 days. See, I have a chance of more profit, less loss. Okay, let's see there. So what happens if I buy a put for 107 for 227 and I sell a call for 235 for 37 cents and buy 100 shares of Apple? My maximum profit in 6 days will be $457 and maximum loss will be 293. So if I divide 457 by 293, it is 1.55. So means I am putting $1 to make $1.50. Okay. Nobody knows what will happen Apple in 6 days. It can fall down, it can go up, it can do anything. But we know one thing, Apple will not remain at this price 6 days from now. Why? because if Apple remains here, nobody makes money. Apple has to move for the traders to make money, right? So this is the way. 23,000 you need for this trade. Okay, yeah, 23,000 you need for this trade. So this is what I call as collar. So collar trade, what happens? I hold 100 shares, I buy a put as a protection for downside, and I sell a call. So the cost of put is covered partially by the sell of call. And tomorrow, maybe in 6 days, if Apple become uh, 235, so how much profit? I'm gonna get 500. I didn't get 500. I get 457. Okay, $50 less, but my protection was there, right? And if Apple goes down, maybe Apple become, let's say it become 200. I'm already out at 227.5. And then the rest of the money what I got, I can use to buy Apple again and 200 if I like Apple again. And I can put the same collar again on Apple. And Apple is not guaranteed that again it will go. It may go one time, two time, three time. Imagine every time your loss is very limited, but Apple is moving too much there. So next time when Apple goes up, to cover this loss, it will take hardly one trade because your profit is more than loss. So if you did 5 trades and 3 success, you are in profit. So key considerations for a caller is selection of strike price, impact on expiration dates, monitoring and adjustment. We will talk about adjustment later. Today I wanted to just introduce caller and get your feedback there on the question and answer sessions. Later we will see how we can adjust and save on the premiums more. And balancing cost and expected returns. What are the risks there? You cap on potential gain. I again said in the previous Apple, if Apple become 240, you are not getting $1,000. You are selling Apple at 235 at your agreed price. Okay, that is the potential, but nobody knows it will go that much high. That you have to be experienced to know what price I should put my collar. Second is premium cost may vary with volatility. If volatility increase, premium cost will increase. So premiums keep on changing. And it requires active management and understanding of options. So you can do it on a monthly scale. So if you do in monthly, you take one trade in a month and you leave it for the month. It goes up, goes down, you don't care. You are freely sleeping peacefully. You take a stock and then you will thinking, oh, tomorrow it will go up, today it will go down. You are stressed. This makes you out of stress. Who cares? In a month it will go wherever it is going, let it go. Finally, the last part of it, address common questions. So this is what I was talking about collar, a simple trading strategy. Okay. And questions from you guys if anyone has. So you can use two interesting things to set up collar. First is your okay. So two tools are there available. First is this one. This is optioncharts.io. This is the first one, optioncharts.io, which is very helpful to design our collar strategies. So let me show you here. If I go to this website, optioncharts.io, and I go to this profit and loss chart, and let's say I wanna build a collar for any share. Let's take I wanna build a collar on Nvidia. Okay, so I go to this profit and loss, and then I can decide here if I buy, let's take the quickest one, closest one for understanding purpose. And if I go ahead and say 141.95, perfect. So I can buy a put for 142, that is the closest one. I add a call sell. Let's say in 3 days I want to earn $300 maximum. So I will do a call sell, and then I add shares of. So I bought 100 shares. I bought my put and I sell my call. Now watch my here profit and loss graph. Do you see the profit and loss graph? I can have a maximum of $192 profit. I can have a maximum loss of $100 only. So imagine this is 1:2 trade it become for a week. So these type of trades you have to take when you work on, when you have a less loss and more profit. And if you keep on doing these things again and again, again and again, again and again, you will be making money. No one can stop you there because you already hedge your losses there, and you don't have to worry about your. See, the put premium was $2.72, which was compensated by the sell call of $1.51. So by this way, you reduce the cost of your hedge, and you are good to now set up there and work on the results. So you can use this website or optioncharts.io to understand about how you do the options hedging and how to master this collar. Okay, always if you work with collar, there are hundreds of techniques, leverage techniques. I don't go on leverage techniques because wanna trade with only my money, and I'm not an active trader. I do it on a monthly basis. I will put it and leave it for a month. It will go up down, I don't care because my both ends are already put there. Okay, so you can use this one to know how options work and how you can work and generate. And I have seen a return of 24% per year. If I have not seen, I will not talk that. But yes, by setting up collar properly, any questions? I think the chat is open. Anybody has any questions can mention there. Okay, so no questions. Then that's all I have. Thanks for joining, and have a great day. Hope it was any useful to you all guys. Thank you.